Thomas Jong Lee, commonly known as Tom Lee, is an American entrepreneur, financial analyst, strategist, investor, businessman, and full-time contributor on CNBC's Fast Money, Tech Check, Halftime Report, and Closing Bell shows. Moreover, he is also the co-founder and head of research at Fundstrat Global Advisors, and is an advisor to New Edge Wealth, a Connecticut-based wealth management firm. Lastly, Lee is the first major Wall Street strategist to provide formal research coverage of Bitcoin to his clients. Check out this video and make sure to like, subscribe, and share. Thank you for watching.
I think that markets are at like a friction point right now because we've had two really good back-to-back year gains. I mean, anyone holding at the start of 2023 is up nearly 50% since then. So I think for anyone looking forward, the risk reward next year is quite different. So I can really sympathize with someone raising cash like Warren Buffett. Part of his selling, he had been doing it throughout the 2024, may have been in anticipation of changes, potential changes in tax policy, like paying a capital gains tax increase. But that being said, if we didn't look at the level of improvement of stocks for the last 2 years, but just over the next 12 months looked at what lays ahead, I think someone can be optimistic because we know the Fed is cutting interest rates, but at a time when the business cycle is still healthy. So in the 7 times the Fed did cut, while we weren't in a recession, markets actually did really well over that period as the cost of money falls. And the second is that I think some uncertainties have been cleared up. I think so much of the summer, our clients were sitting on cash and getting nervous. And you could see it in the VIX index because they didn't know who was going to be president. But now that election is behind us. And while I don't think anyone knows what policies are going to emerge, because there's a lot of radical policies being offered, including cutting government spending, etc. I think it's going to create opportunities for many companies. And I'd say that the way we would sort of look at that is we'd want to be looking at smaller cap stocks because they've really been held back the most. And the third thing I guess is constructive is by the measures of like how people have deployed cash, it's still a pretty cautious market because margin debt hasn't risen for 5 months now. So that's not typically a sign of euphoria. It's usually a sign of exactly what you said, people getting cautious. And even like investor sentiment, like AAII actually has fallen away. So we're at not that level like where people are so bullish that you have to start to turn bearish. I think when it comes to earnings and saying earnings are extended, the one thing that has happened this year is earnings have been beating by a huge margin. Even third quarter earnings have beat by 5%. So I think that the trajectory of profits is still better than most people have modeled, and that's a source of positive surprise. Bitcoin 1 year from now, I think is something around 250,000. Part of the reason we have stayed constructive on Bitcoin is the price is following closely the prior halving cycles. The halving cycle is when the block reward gets cut in half. That happened earlier this year. So there's a reduction in new supply. And the sweet spot of that price gain as supply is cut starts to happen towards the end of this year and then into next year. And I think that has supported why we expected Bitcoin to be 100,000. And over the next 12 months, I think something over 250,000 is possible, but maybe highly probable based on just following this price cycle. The second reason I think Bitcoin has maybe more upside than that is because the new administration has run on a pro-Bitcoin platform. And I think that the possibility of the US not only legitimizing Bitcoin, but making it a strategic reserve asset, I think raises what would be the possible price scenarios for Bitcoin. Because if the US government, as they intend, ultimately gets to 1 million Bitcoin, they'll be the largest holder of Bitcoin in the world. And they'd exert enormous positive influence on legitimizing Bitcoin. And maybe I would just add to that, it's almost like taking a playbook from MicroStrategy because MicroStrategy has proven that using Bitcoin as a balance sheet asset has really created a lot of value for MicroStrategy shareholders. Yeah, very good. But knowing that it is hyper volatile, Mark Newton, our technician, thinks that the cycle of Bitcoin turns a little bit down early next year. So maybe Bitcoin gets to the 60s before 250. To me, the most important really is grain prices, because they've actually been softening. That would be really welcome if grain prices fell, because that would take the front end of food inflation out. Some of that could be because markets are trying to price in an ending of the conflict in the Ukraine, because that would help bring down grain prices, because it would just take away friction from the market. With regard to tariffs, I think that there is a lot of saber rattling, because throwing 300% tariffs on products would be, of course, very economic. It would just create so much turmoil in the economy. But what I have heard from Chinese manufacturers, because I was on the West Coast this week meeting with a group of businesses, is that China has already reduced the tax refund for Chinese exporters, meaning like someone who makes an air fryer, if they were getting a tax refund from the government, that's how they're subsidized, that amount is reduced. So they're essentially rolling back the subsidy. And I think that will have the effect of negating the need for tariffs, especially because I think China's economy is a bit weaker. So if those tariffs were designed to get China not try to engage in hostilities economically, I think it's actually probably working. I mean, that may be a surprise, because I'm not sure it's widely known. I asked a lot of folks if they'd heard this, but that's what I've heard from a manufacturer. At least in the beginning, it makes sense to expect it, even if it hasn't been delivered. On taxes, as you know, a lot of folks have been writing that it'd be very difficult for the U.S. fiscally to actually extend or even expand the tax cuts. And I think the bond market's going to really ultimately decide that. And because if yields keep creeping up because of growing deficits, I think that it's going to be hard for the White House to accomplish that. I mean, the White House is watching the stock market. The stock market would come under a lot of pressure if yields keep going up. I would say, to me, even though that's a goal like tax cuts, I'm not sure that that's going to be achieved without some way to convince bond markets that someone will pay the bill. And maybe that's because maybe you need a crypto strategy before you can actually do that. I think Fed Chair Powell is really independent. He's done, in my opinion, a great job. I mean, he's navigated the U.S. financial system through the pandemic and then an inflation war and then actual wars. And I think he's handling the threats of his lack of independence well. I think he's done a great job. And if inflation doesn't provide the visibility that it's falling and the labor markets aren't faltering, I think it makes a lot of sense for the Fed to slow the pace of cuts, because I don't think they're turning hawkish. They're just simply trying to keep a lot of dry powder in case they need to make cuts later. And right. So I think their strategy makes a lot of sense, but also I don't think it's negative for stocks. But yes, I mean, it's going to be, as you know, like a lot of well-known investors have warned that, the U.S. does have a more tenuous fiscal position. So I think that's why the Fed is going to be very important in the next few years, really trying to contain market fears. Yeah, that's still our case, our base case, that we're in an earnings-driven cycle, aided by AI, also supported by this prime age workforce surge coming from millennials and then also Gen Z, because those two generations are larger than Gen X. So Gen X is the generation born between 1960 to 1980, roughly. And those folks are, just in the heart of the prime ages now. And now they're exiting, and now you have two huge generations behind it. So think of it as like a second wave driving further growth. S&P earnings next year are roughly 300 for, let's say, just sort of simple measures. And so that's why S&P 6,000 is just 20 times earnings, right? Which I don't think is that demanding. By 2030, we estimate S&P earnings could be 600 to 650. And I think multiples will be higher because of the larger share coming from AI and technology earnings, which naturally have higher PE multiples. And so if you just apply a 20 to 25 multiple, you're getting, 15,000. So I know it sounds like people say, well, 15,000 sounds crazy. And 2 years ago, it might have sounded crazy, even though that forecast was in place more than 2 years ago. That forecast has been in place probably for 5 or 6 years. But, now that we're at 6,000, we're that much closer to 15,000. It's not a quantum leap any longer. I would say, based on my conversations with our clients and with other sort of folks following this, I do think we're underestimating the negative consequences of AI, foremost because in our human intervention endeavors, we work with ethical boundaries, because even though there might be a shortcut, Like, let's say you're waiting for coffee, you wait in line and other people are in front of you. But in an AI world, there's no benefit to being ethical. In the AI world, that machine will just cut the line in front of everybody to get coffee. And I haven't seen any attempts to create ethical boundaries within AI, especially other nations pursuing it. So to me, this means there's going to be much greater risk of cybersecurity hacks, and it's going to be much harder for us to protect our identities in this world of AI and social engineering and generative AI videos, and it'll be very easy to spoof people. And so I think profits are going to do fine. There's going to be a much higher cost in the economy around cybersecurity, and already JP Morgan, 7% of their activity, well, all banks really, 7% is now suspicious. It's actually been rising. So in a world of cybersecurity, banks are kind of losing the war because there's more fraud now than less. And so I think that makes crypto so much more important because it does secure your information. I think that's one solution, so I think there's a lot of risks, actually, personally. I think if you unleash AI systems in the financial market, there's going to be a lot of people who make dirty trades that trick people and spoof people. And there'll be fake headlines because that's how you manipulate markets. Historically, hedges for inflation have been land, like owning real estate, owning gold, which I think is still valid. But I think now there is hedges using crypto, because crypto is also a hedge against dollar and currency debasement, which is on top of like inflation risk. So I think all of those are valid inflation hedges. Of course, if you are open to alternatives, even things like art and collectibles are pretty good inflation hedges as well. For most of this year, what we recommended to our clients are really 4 sets of trades. The first is AI related trades. The second is small caps, because the Fed is dovish and they're easing, and that's going to boost their small banks within small caps. The third is we've recommended financials and industrials because the Fed is easing. And the fourth is Bitcoin, because a dovish Fed along with this halving cycle. So those are the 4 trades. With the new Trump administration, those 4 trades are also the same recommendation, because now you have a White House that wants the stock market to go up. So there's a Trump put now on the stock market. And now there's a Fed put, and that supports small caps, financials and industrials, and Bitcoin. And so, of course, the AI trade, I think, remains strong. It didn't need a Fed put or a Trump put. If you want to know what to hedge yourself with, is just to see what's done well in the last 8 years as a political hedge. And one, it's obvious that Bitcoin's been a great hedge against political uncertainty, because it's censorship resistant. If you own the keys, you own the coin. No one can seize it from you. Technology stocks have been great political hedges, because at the end of the day, demand for technology has nothing to do with being in favor with one political party or the other. Technology companies like the Mag 7 have just changed the world, and they've become really important. So I'd probably say that those 2 are your safest. And of course, the third would be gold, because, as this election went underway, gold actually did very well as people worried about election outcomes. I might just need to explain for some other viewers what MicroStrategy is doing. MicroStrategy, around 5 years ago, transformed the company by using its balance sheet. They had a lot of cash on hand to buy Bitcoin. And so instead of the stock being valued on its actual software business, which had been languishing, it's valued as a holder of Bitcoin. But as Bitcoin has risen and MicroStrategy's stock has gone up, it's created an opportunity for them to issue convertible bonds and debt to acquire more Bitcoin. What's been novel is that they've issued these debt securities for almost no interest cost, essentially zero interest bonds. And so they're funding this without having to actually pay for the interest expense. Now, you might think that this is a little bit reckless, but it turns out it's a very novel strategy, because they have created a lot of network value. They're one of the largest holders of Bitcoin now, and ultimately they may become the second largest holder of Bitcoin after the US government. And they're doing this with the ability to borrow at very low cost. You might wonder, why are bondholders buying these bonds? They're offering for the first time the ability for someone to put $1 billion of work in the bond world to own a bond that has exposure to Bitcoin. These have been incredibly high-performing bonds. They've been the best performing bonds. So they've helped bond managers outperform by buying typical corporate bonds, but then with this upside in crypto. And so I think that this works unless Bitcoin itself doesn't have a promising future. I think Michael Saylor has not only done something brilliant, but over time, when they do accumulate enough Bitcoin, they're actually going to be able to do quite a lot of novel things with it, whether it's lending Bitcoin or helping some financial system secure Bitcoin as sort of the anchor of that network. MicroStrategy is going to be one of the few companies that has a large holding of Bitcoin that you can actually tap. So I kind of applaud the strategy. So I think that there is a lot of upside in what they do, because as long as Bitcoin goes up, MicroStrategy very likely goes up a lot more. I think the toughest thing people do is when they have a winner, they try to diversify out of a winner. So I think it's important to hold on to some great ideas as long as you have done the work and you're convinced that that great idea still works. I think you need to hold on to winners. So if you're saying that you ended up with a lot of crypto because it's risen a lot, you just have to, as they say, hodl, because you don't know what the ceiling is. The biggest lesson for me, because we've been following crypto for more than 9 years now, or on our 9th year, really. The one thing that people have been saying for many years is that something is going to replace Bitcoin. And so you want to own the next Bitcoin. But all I've seen is Bitcoin's dominance has been really untouched. So I would just say, whatever you do in crypto, just know that Bitcoin has to anchor your strategy.